Often, when you're investing, it's very hard to find an accurate value for a company. And that's actually very important because it can help you to determine which is a good price to buy it at or sell it for that matter. In this video, I'll be discussing three main definitions that you need to know when valuing a company. So, our first definition today is our asset value. Your asset value is the total value of a company's tangible and intangible assets. So tangible assets are basically stuff that actually exist. So for example, this can be properties, vehicles, it can be cash that's just lying around or cash that's owed to them from other companies, for example. And so you also have your intangible assets, which are things like goodwill or your brand value or stuff like that. And if you add those two together, you get your asset value. Our next definition is your net asset value. So this is your asset value that we just discussed minus all your liabilities. So liabilities are things that are basically like taking money from you. So for example, this could be debt that you owe someone, right? And so if you minus these from your assets, you get your net asset value, which is a good representation of the total value of a company, right? Because then, like even with these assets, even with these liabilities, this is how much the company is worth, right? Our final definition is your book value. So this is just your tangible assets, so your properties, cars, cash, whatever, minus your liabilities. So this doesn't take into account things that are hard to calculate, like your goodwill or brand value. It's just stuff that actually exists in the moment that's easy to sell, for example. So this is a good metric for knowing your liquidation value of your company, right? Because let's say everything goes wrong, right? This is how much your company can actually sell like this stuff for. So when investing, asset value is generally quite a useless term on its own. However, net asset value is very useful for determining the value of businesses that, for example, might have a strong brand and large amounts of intangible assets. Because even though, say, they might have high debts, their intangible assets make up for that. However, your book value, which is your other value metric that you can have in a company, is better used for, like, for example, companies that you're value investing in to just try get the assets out of it. So companies that have, for example, a very low share price compared to their asset value, or should I say their book value, right? Because then you can make money without much risk. So generally when investing, you want a net asset value or book value that's very similar or even higher than your total market cap of a company. Because this means that, let's say if everything goes wrong, they can still sell all their assets and you as the investor will be still protected, right? So anyway, if you enjoyed this video, please do consider subscribing and also liking this video to help out the algorithm and help me promote investing to more people. Anyway, thanks for watching this video and I'll see you next time. Bye.